Welcome back. You're tuned in to Editor's Roundtable. Now, there's plenty of talk about tariffs, what is Trump going to do next, and what's going on in the other emerging markets. But there could be one space to hide, and that's purely domestic, or goes according to domestic factors. That's the cement space. The question is, since there's global uncertainty, will cement be the place to hide in? Well, just looking at the consumption, things look good, actually. You know, the data that we got in, the core data that we got, said that in January, you had closer to 14.5% growth, which told you that this growth is coming on a low base. Also, capital expenditure has perked up yet again. So that's much better in comparison to what we have seen in the previous 9 months. And for the year itself, now this is the production number, the street is working with demand of close to around, demand growth of around 7 to around 8%. Keep in mind that in March, you have a higher base. Though in February you had one less day and also you had Mahakumbh, so there have been some dispatches in central India that's been impacted. So give and take everything, demand looks pretty okay with a growth of close to 7 to around 8% in Q4. That's what the street is working with. Next up, in terms of pricing, we have been covering this fact, right? That pricing has been absolutely dismal. But on a quarter-to-quarter basis, at least prices are up by around 2 to around 2.5%. So that's what will support some kind of growth in terms of realizations. While there is an attempt to push through 10 to around 20 rupees per bag. But, you know, this is being met with some resistance because it's towards the end of the year. You have a big festival as well, which is Holi. And also you'll have the year-end volume targets. So there'll be a lot of pushing of volumes out, which could question this 10 to 20 rupees per bag increase that the street is trying to push through. So that's on pricing. Pricing relatively higher, demand as well fairly good. Input costs. You know, coal prices, they have continued to decline, and that's a positive actually, because thermal coal prices are down. The problem is there is some imbalance in pet coke, and that's why those prices have gone up. However, cement companies, you know, they can source a higher amount of coal, and they'll be able to adjust this. And keep in mind that crude oil prices have come down. Normally, you see that pet coke prices as well could follow suit. So input costs are expected to be benign. However, for margins to hold out, you'll have to see a couple of price hikes to move through. Because as of now, they'll gain the benefit of lower input costs. But if pet coke prices remain stubbornly high, that's what could put some pressure on the EBITDA per ton. So for Q4, we in all probability should see an increase of close to around 150 to around 200 rupees per ton on a sequential basis on EBITDA per ton. However, to protect the margins in Q1 FY26, you'll have to see some incremental price hikes that go through as well. Finally, valuation-wise, well, in comparison to the averages, not too bad, you know, because this has been a sector as well that's corrected in line with the market. But given that there is uncertainty on the global front, with Trump's tariffs, with what's going on in China, will cement be the place to hide? And if there is going to be an uptake in capital expenditure, this could be an indirect play as well. So we'll keep an eye out.